Welcome back. You're watching Stockwatch with me, Julieta Televi, and joining me to take your stock-related questions this evening are Zwelakhe Mnguni from Benguela Global Fund Managers and Wayne McCurrie from FNB Wealth Investments. If you'd like to send questions, please SMS 41392 or email stockwatch@bdtv.co.za. Zwelakhe, Wayne, good evening to you both. Zwelakhe, if I may start with you, it's not your usual gig on a Wednesday night. The market was flat today, so no recovery after yesterday's thrashing. And it's a bit tough out there at the moment. And I think I'll start off with a question from a viewer, because maybe it'll kick things off for us, who says, with such uncertainty in the market and the Middle East, does the panel see a major correction or a crash looming? What's your feeling?
Yeah, look, I think today we are flat, but I mean, I think we saw a big bounce in the resources space. I think the financials offset that to some extent. So the likes of Upside and Old Mutual were down quite a bit today. But I think in the Middle East, or the global, the question around global correction, I think the correction can only be driven by earnings at the moment. I don't see any major risks outside of geopolitics. I think geopolitics could come through and they could spoil the party, but I think outside of that, I don't see any major correction coming through. I think the US is relatively strong. The companies that are leading the performance in the US are actually underpinned by quite strong cash flows, strong earnings growth, and so we are also seeing that China is also improving. So I do think that we probably might go sideways at worst and probably build up to a momentum of upward trend.
Wayne, is that what you would see? And that'd probably be the best of a very set of uncertain factors that just about every economy in the world is facing.
I mean, geopolitics, you never know. I mean, they start attacking each other with nukes. Then we're going to see a major correction, obviously, but that is highly unlikely, if not impossible, to happen. It would be extremely unusual to have a major market correction on the cusp of a cycle of lower interest rate. Now, when I say the cusp, this has been pushed out, and maybe next week some more inflation numbers come out that's positive, then it gets brought forward again. But over the next 2 to 3 years, we are more than likely going into an interest rate cutting cycle. And it would be highly unlikely for a market to correct in that environment. But understand, a 10% fall or a 15% fall is not a market correction. That can happen for any reason. And sometimes it happens for no reason.
Yeah.
So, that, 5, 10, 15% would actually be quite normal market movements downside. But a major correction of 40% or 30%, other than geopolitics, I doubt that in the extreme.
So we've been talking about it for the last couple of days, and we did mention it on the show last night. And a viewer says, possibly as a follow-up question, as there has been some general comment of late about rising US 10-year yields and the apparent risk that implies for equities, if your Wednesday evening gurus could please explain what is causing such yields to keep creeping up, and indeed what risk that may hold for equity markets, whether in the United States or globally. Zwelakhe, so you've got slightly rising yields on the cusp of an interest rate cutting cycle, so it's a little bit confusing at this juncture.
Yeah, I think that the one issue has been that the rates had actually dropped ahead of the expectation of a rate cut, so the market is recalibrating that to delay it further. So I think it's nothing extreme. I mean, there are obviously concerns around, as we said, geopolitical issues, but I don't think that's a major issue at the moment. The creep up is mainly more related to that the market is recalibrating. It had moved too quickly forward in terms of the expectations, and that is something that it had to recalibrate.
Wayne, your thoughts there, and maybe specifically in South Africa, you see that the longer bond yields are going out quite a lot. So I think, what are they approaching 13%? Yes. What does that say? Is that not necessarily tied to what our interest rate cycle is, but to nervousness about the country's fortunes, especially on the cusp of an election?
Yeah, look, I mean, don't overplay the election story. I mean, I don't think I think that's something we're going to hear a lot about before the election, but you know, we'll see what happens on that. But US long bonds are going up, our long bonds going up. But I mean, over time, I have no doubt whatsoever that the Reserve Bank will do whatever is necessary to keep inflation at acceptable levels. And let's just say acceptable levels of 5%. I mean, they'll probably want it lower than that. But you buying a yield at 11, 12, 13%, I mean, unless you think the government's going bankrupt, that is an extremely good yield to just bank. You can just bank it, you know, from now until whenever. It really is good.
Yeah. But just, and going back to the, whether you see a lot of risks ahead, maybe we answered that, to be fair, after the first viewers' question, but with higher bond yields. Do you see, is that a warning sign for you for equity markets?
It's really dependent on what you think the next move is going to be in bonds. I mean, bonds have been going up strongly from under 1% from mid-2021 to the current, call it 4.6 on the US long bond. And that is never good for equity. But despite, and of course, short-term interest rates rising should also never be good for equity. But despite all of that, equity's been quite good. Admittedly, a lot of it, we get a bit bedazzled by it. A lot of it is a recovery off the big sell-off we saw, you know, a year ago in the tech shares. So we sit with a very unusual set of circumstances. Normally, you would have a big market correction with the rising interest rates that we've seen, both long bond and the short side, and we haven't seen anything like that, obviously. So this will honestly be the first time we haven't seen a serious market correction in a rising interest rate environment. When you look at the valuation of the US market, it's not massively overvalued. The market as a total isn't. So, you know, as long as you believe the next move in interest rate is down, both short-term and long-term, the current rate shouldn't pose too much of a problem for the share market.
Okay. Then there's quite a few questions on banks, because everyone's banking stocks have been a bit whacked of late. At a certain point, and not too very long ago, my Standard Bank shares were up 20% year on year, and now I think they're up about 5%. So I feel a lot poorer. And so the three questions that we have are the one on Capitec. The viewer says it's down around 11% since the 8th of April. Are there any underlying issues that are causing this big drop, or is it just the current market conditions? Someone else has asked on Standard Bank. He says it's come off substantially over the past few weeks. Does the panel see this as an opportunity? Would they be investing in Standard Bank at the current levels, given that the bank pays a fairly high dividend? And then, there's a question on Nedbank asking whether you could give your views for the next 6 months. And do we expect the SA economy to grow? Okay, so Zwelakhe, I just try to shoehorn all the banking questions into one segment. But starting off with Capitec, its decline, would you explain it by virtue of what's happening to the market, or are there some Capitec-specific issues?
Look, I'll probably say there is a bit of both. So the banking sector has been under a bit of pressure in the last half month. I think the main reason is also the fact that the bond yields have risen, and part of their reserves are held in government bonds. So that has played a role. But I also think that they've had quite a strong rally in the last 3 months, and certainly people have been taking profits. On Capitec itself, I think the banking sector has seen a slowdown in lending, and Capitec has been part of that. And they have actually tried to bring the lending under control. So they've throttled the lending criteria given the current environment. But I think it is positive in the sense that it will lower the impairments down the line. So I don't think it's a bad outcome. But certainly it's probably the most highly valued stock in the sector, partly because of their returns that are driven largely by personal loans. So their diversification into other areas like home loan and vehicle finance and business would actually mean that their net interest margins in the banking sector might come under pressure, but they might be able to offset that with non-interest income. So I think I'd probably still be positive Capitec long term.
Okay. Wayne, I don't know if you have any particular burning thoughts on Capitec, or if you want to talk about Standard Bank and Nedbank.
Yeah, look, Capitec itself went up quite strongly. This fallback to 2000 is nothing unusual at all. It went up quite strongly in the very near past, and it's been sitting at about 2000 for a long time. So I wouldn't worry. There's no specific issues on Capitec. All the other banks have taken a pounding. You can get these things at between 7 and 9% dividend yield. Looking at Standard Bank in particular, there's no major issues. Absa is a different story, but there's no major issues with Standard Bank, that's for sure. And when you look at the share price chart, since the COVID collapse, it's been in an overall rising pattern, but it's had these retreats down quite a few times, about 5 times. So it's very likely it's going to bounce off this type of level. Absa, we know from the previous set of results, the earnings were not good there. I mean, they really weren't good. But I mean, Absa's at a 10% dividend yield, and the divvy's not under threat. It is just too cheap. These banking shares show, very good upside. And just as a general comment, when something like this happens on banking shares, you are swamped on any share. You are swamped by bad news. All you'll hear is bad news. It doesn't mean the share price can't go up, because it doesn't mean the news can't change.
Can I just ask, though, and to the viewer's question about whether or not we have if our economy continues to stagnate, and you had the IMF very bearish on our outlook for jobs creation, which, hopefully someone in government is listening to. But if you've got that stagnant economy, and notwithstanding their high dividend yields, are banking shares not really the place that you want to be? I don't know, Wayne and then Zwelakhe.
Markets look forward to what's going to happen into the future. Now, maybe I'm too optimistic, etc., etc. I've been accused of that often. But if you take a slightly optimistic view about South Africa, in 2 years' time, electricity is not a problem, because the private sector is going to generate vast amounts of electricity. So hopefully 2 years' time, load shedding is behind us. Maybe not get it done in 2 years, but there will be a significant improvement in Transnet and logistics, because effectively that's being privatized as well. But most importantly, if we get interest rate cuts coming along, we should get a commodity upcycle. I mean, I'm a stuck record. We should get a commodity upcycle, which will be tremendously good for South Africa. Then our growth rate is not stagnant. Then our inflation rate's not going up. Our interest rates are going down. Then the rand is strengthening. There is a completely different environment to where we sit now. And under that environment, the banking shares will do really well. You must look forward.
Yeah. A last word from you, Zwelakhe. Would you be prepared to take that risk on SA banking shares?
I'll definitely take that risk. I think there are a few areas that are safe for them to actually grow their books. I mean, this renewable energy round 7, I think it's a great opportunity for them to invest in that and drive their book growth. And then you have, if we hold everything together as where we are in terms of tax collection, in terms of our current employment, I think we should be fine in terms of the growth. I mean, they should be able to get through this current environment. But on a 5-year basis, definitely positive about banks.
Okay. Just a quick question from a viewer asking, how could he access banking pref shares? Zwelakhe, and would you access bank pref shares at this point?
Yeah, I think pref shares are quasi-equity. I mean, they halfway between ordinary shares and the bonds, kind of, if one could think about it that way. And certainly, the pref shares are offering decent yields. So if you're holding some pref shares, I think it's a good way of enhancing your fixed income portfolio.
Wayne, I mean, they're quite easy because a lot of people have kind of, I suppose, bought back their pref shares. They kind of fell out of favor as capital instruments.
Yeah, they did fall out of favor raising capital instruments. There are some tax advantages for both the bank and the investor in pref shares. But I'm going to be a little bit controversial here. I've never met one happy person who bought a pref share. I've never met one person in all of my years who said, hey, I bought a bunch of pref shares and I made a killing and I'm so happy. Never met one. There's no liquidity in the market. It's fine if you hold them to maturity, but if you want to move out in the shorter term, you're at the mercy of the person making the market in there. It's actually quite a small market.
Yeah. Okay.
So I personally, my own personal view, I would steer clear of pref shares. I really don't like them.
Okay. All right. A question on the US market. It's quite an interesting one. And the viewer says, recently a fund manager pointed out that for a very long time, at least since the 1980s, the main contributor to market growth in the US was low interest rates and not earnings growth. The latter was about 2% per annum, if I remember correctly. In addition, tax rates were significantly reduced. Do the panel members agree, and how would they invest or not invest for the future? When I think about the future, which nobody can predict, I get a feeling that we're not in Kansas anymore. Certainly, I think that is a view shared. One does feel that we're at a very precipitous time in history, but maybe it's always like that. Zwelakhe, is that the case, that earnings growth hasn't necessarily propelled the US market? I would have thought differently, but, you know.
No, I think differently. I think they have contributed. It's a question of how big the contribution was during different periods. So if you go 1980s to maybe the 2000s, there was a very strong growth in earnings that was blended between the tech sector and the industrials, particularly in the US. And then you had the dot-com bubble that then collapsed the tech sector. But then they rebuilt, the consumer discretionary came through in the post-dot-com bubble. And then we had right at the end, the financial shares coming through. So there has been growth. And I think the interest rates have played a role in the expansion of PE multiples of the market as a whole. But I certainly think that there has been a meaningful contribution in terms of the value of the earnings that have come through over time.
Mm. Wayne, is there anything different from, the feeling that we're not in Kansas anymore? I suppose it is a brave new world, but is it always thus? And does it make you, should you invest differently or not?
No one knows the future, as the viewer said there. But ultimately, earnings drives the market. That's it. Ultimately, the ability of the capitalistic system to generate earnings drives the market. And as things evolve in the capitalistic system, the companies change, the companies evolve, new ones come, old ones disappear. Capitalism is very, very adept at changing circumstances. So I wouldn't worry too much about changing circumstances into the future is going to severely affect earnings structurally, because companies restructure, the old ones disappear and the new ones come on. But the point is, the market's value is at what rate do they discount those earnings? And in fact, it's future earnings projections more than historic earnings. So in the 70s, in rising interest rates, market got clobbered. Even though it was making earnings, the ratings of the market got clobbered because inflation went through the roof. And then essentially, since 1981, with a few wobbles along the way, we've seen a consistent decline in long-term interest rates, which means a consistent improvement in the rating of the market, but it's still the same earnings that you are rating. And if earnings didn't grow, then the rating of the market would just fluctuate up and down with the interest rate pattern. So ultimately, earnings drives the market in total. But in any particular stage, it's the effect of interest rates on the discount of the market that gives you the actual level of the market. So in other words, when long bond went down to 1%, below 1% after the global financial crisis, the market was only going one way, and that's up. Now it's gone from 1% to 5%. You can argue, okay, the market shouldn't have done as well as what it did do, and maybe some 10%, 15% fall will be warranted. But when interest rates go down again, which I think they will over the next 2 to 3 years, the rating can be maintained. So, but ultimately, earnings determines the valuation of the market, but it's the discount rate that determines the actual level of the market.
Okay. Moving on, there's a question on MTN. The viewer says it went ex-dividend today, and the graph looks like my heart rate on the treadmill. Which is curious, because really one's heart rate should be going up, not down. Zwelakhe, it's not a very pretty graph. Have you also similarly lost faith in MTN?
Look, I think MTN is facing some challenges around their Africa operations, and I think the main challenge is around the currency depreciations. I think Nigeria's sharp currency devaluation has a material impact on what MTN can translate into rand or into dollar. Their capex is in dollars, and they need to pay for capex they then receive in naira. I think that creates a big problem for them. So structurally, I think the currency situation is a big problem. They've done a lot of positive steps in unlocking value, selling some assets, and adding mobile money. But I think the big picture is that the currencies will overwhelm the overall execution. So I'd be a bit more cautious about it, even though where it is, it's probably looking quite attractive. I mean, I can't say when would it improve, but I'll probably say it's probably looking quite attractive. The big picture is that the overall currency situation has depressed the value of the share.
Wayne, do you see that changing anytime soon?
Look, you just don't know. I mean, the share is super cheap, but they're super risky as well. I mean, you just don't know what's going to happen next week in Nigeria. Is there some new fine they're going to come up with? Will the latest currency stories actually hold? What you just don't know. One thing as well on MTN, they can only borrow in dollars. Can't borrow in the local currency. There is no market. So you borrow in dollars, your capex is in dollars, and then you earn in a massively depreciating currency to try and repay all of those loans you took out to buy the capex, and the capex is huge. So unless things truly come right in Nigeria and the country's managed properly and the forex is managed properly, and or the oil price goes to $120, I wouldn't buy MTN.
A very quick question on retailers. A viewer says, why are retail stocks like Woolworths, Spar, Pick n Pay currently at all-time lows? Well, not quite. They just are a bit depressed. And what's the cause of this? And when will we see these retail stocks recover? More specifically, Woolworths, when will it go back to its highs above 70 Rand again? As we're lucky, the retail sales numbers were out and they weren't great. Not like the US, sadly. Would that explain the depressed state of SA retailers?
Yeah, I think the SA retailers have done very well relative to the economy, and I think they had a rebound from the COVID, and they continue to perform, particularly the food sector as well. I do think that the likes of Pick n Pay have their own problems, which are execution, less relevance to the customer, that they don't belong anywhere. I think Shoprite has done very well. They've executed very well. I think that's been rewarded as a result of that. And Woolworths, there seems to be a sideways direction. One of the big concerns is now that they are bringing like a kind of departmental store model into Woolworths. And I think that's what collapsed Starterford, that's what collapsed Edgar's at one stage. So I'd be a bit cautious on the fashion side. I think the food business is fantastic.
Interesting. Yeah, you're seeing sort of quite a few different brands within Woolies. Just linked to that, and sorry, I'm not going to ask that specific question, but to you, Wayne, before we get to our stock picks, a viewer asked whether or not Pick n Pay is still investable.
I would steer clear. Normally, I quite like these deep value situations, turnaround situations, but I don't know whether. I honestly don't know whether you can turn the company around. It's going to need the biggest cash injection, and it's going to need to spend that cash in many, many areas that are difficult to get right and takes a lot of time to actually get right.
Okay.
You are faced with such competition with Shoprite.
Yeah.
You're 20 years behind Shoprite. It might take you 20 years to catch up.
Okay, very quickly between the two of you, your stock picks. Zwelakhe, what's yours this evening?
Yeah, I took a bit more defensive position against the geopolitics, and I went with Lockheed Martin. It's a defense company, US-based. predominantly US government contractor, and they are getting new orders as the tensions rise in the global scene. I think the Russia, US, Europe tension, the stock might benefit from that. It's not expensive. I mean, it's trading at about 16 times, and certainly a business that has a relatively stable earnings stream. So it's a business that I think would provide some defensiveness against any geopolitical risk if it does materialize.
Okay, great. Wayne, how about you?
I'm going for Netflix results coming out now. Maybe wait for the results first. I think they're going to be quite good, but there is some risk in that. So I'm taking Shapiro's place today. I'm buying a bottom left, top right share for. So I'm just standing in for Shapiro.
Okay. Actually, someone said every time David picks Estee Lauder, all I can do is buy cosmetics, because they're complaining about not having access to local stocks. So maybe that is something that we can discuss next week. But I have to leave it there. Zwelakhe, Wayne, thank you very much for joining us tonight. Always a pleasure. Zwelakhe Mnguni is from Benguela Global Fund Managers. Wayne McCurrie is from FNB Wealth Investments. And up next, the close. Stay with us.